in the future you can't afford, your 1,000 has less value. Even your savings has less value compared to what the actual return is right now. If you're an investor and you're, let's say, earning in dollars, that's a benefit to you.
Our investors there, or an investor is there looking and saying, what can I do in this time? Yes, inflation is here with us. What can I do to protect my money and to ensure that I still experience growth in my portfolio despite the inflation levels we are currently experiencing?
That's a very good question. I think for the most part, first of all, they have to understand, I think that's why this video is very important, for them to understand what is this inflation and what's the impact of it. So it affects you as a consumer when you're buying your goods and services, and when you're paying for transport in your matatu, if you're buying your goods in the supermarket, it affects that. So it makes it very difficult for you to afford, right? And also now when you're looking at savings or your investments, currently and also into the future, you have to take into consideration, one is, for example, right now inflation is at 7%, 7.1%. So if you're earning any interest, for example, in your investments that is below 7.1% currently, that means you're not able, your investments are basically not growing. There is something we call the nominal return and a real return. So your nominal return, if you're, let's say, earning an interest at a bank at 6%, that's what your nominal return is. But your real return, how investors can look at it is, you take your return, which is 6%, for example, minus you minus that 6% minus the current inflation. Assume the inflation, just for simplicity, is 7%. That means your real return is minus 1%. So that means you're already behind. Against what inflation is right now. So in the future, you can't afford, your 1,000 has less value. Even your savings has less value compared to what the actual return is right now. So in order for you to generate the right return or make the right investments, always think about, for our investors, they have to think about the real return. So they have to say, my return is X%, then you minus your inflation to get your actual return or your real return. So in this case, something that is advisable is, if our inflation currently is at 7.1%, you need at the very minimum to put your money in an investment that is earning above 7.1%. For example, our money market fund is doing at least 9%. Our fixed income fund is doing at least 11%. So with investing in those type of products puts you above inflation and gives you sort of like a fighting chance during this sort of period where inflation is rising. Because our inflation just a couple of months ago is in the 5%, almost 4% region, which is very low. So your bank deposit could, cover that return. So right now, for investors, they really need to look at real return as opposed to that nominal return.
Wow. Wow. Thank you. Learned something on getting the real return, because sometimes you are promised a return and you think you are doing well until that point you do the computation of the inflation. So that's good for us. We enjoyed. And maybe something you need to highlight is on the effect of the depreciating Kenya shillings against the dollar. There are those people who do imports. There are those in the business which have been affected in that area. What should they do at this time?
Just to give context, the dollar has been rising across. The dollar has been, rising or strengthening against many currencies. Kenya, as at the time we're doing this video, our shilling has depreciated, or sort of depreciation is basically what we mean by that is falling, the value of the shilling becoming less than the dollar, currently by 4%. But I think we are relatively healthy right now compared to other African countries. For example, Ghana is down, the currency for Ghana, which is the Ghanaian cedi, is down 29%. The Egyptian pound is down 19%. So West African currency, which is called the XOF for the XOF, is down about 8%. So many currencies are weakening against the dollar. And why that is the fact that the US central bank, which is the Fed, has increased their rates. When they increase their rates, it becomes more attractive for foreign investors to put their money in the dollar, because you're getting better rates, and the dollar is basically what they call the de facto, or the stronger currency overall. So you'd rather have your money there where you're earning a higher return, because for the most part, why they come to us is because the rates there are very low. So they come to us taking some risk to earn a better return locally. But now, given that returns are improving there, that they're selling the assets here in Kenya and all other African countries, Asian countries, South American countries, all these sort of developing or emerging market countries, and taking the money to the US. So the currency becomes stronger there. So when it's stronger, our currency just becomes weaker. So so we've seen a weakening currency all across. So there's our expectation that the dollar is going to continue stronger, and we're going to see a weakening currency. So when it comes now, with that knowledge in hand, what our investors can look, or people watching this video, is to understand that if you're an investor and you're, let's say, earning in dollars, that's a benefit to you, because now your value, that means if at the beginning of the year your salary just remains the same, for example, you're earning whatever dollars you're being paid, your amount is stronger by 4% currently compared to the beginning of the year, meaning that your income remains the same. Say you're paying $10,000, but you can afford things like it's 4% higher. So basically, it's like you've received a salary increase with the market, right? So you want to be in dollars. For example, for us, we offer a dollar return on our money market fund, and we also on our fixed income fund. So that helps those type of people who are earning in dollars. They're able to save in dollars. So if you're able to get dollars, you're better off sort of saving those dollars for now, given that the expectation is for the dollar to remain stronger. And then if you're not earning dollars, let's say you're receiving money from your relatives, what they call diaspora. So your relatives from America, your relatives from the Middle East are bringing money to you. If they're giving you dollars, you can convert some of the money to shillings, so you can be able to meet your day-to-day needs. But if you have a chance to save, you can save also in some of those dollars, which again, if the dollar remains higher, then you can always convert in the future and get a more value. I think for importers and anyone who's dealing with dollar, it's all about taking the right hedges. There are sort of contracts that are offered by banks, like forward contracts, anticipating future depreciation, and so it's just being more informed about it. That can be a video for another day, but for now it's just a focus on telling investors that to be more aware of what's happening, and I think this type of videos will help create that awareness. And if there's more questions that our viewers may have, they can always email us for more clarification.
Wow. Thank you, Charles, for helping us understand today about inflation. And what you are saying in simple terms is that you can't afford to keep your money in the bank earning zero interest, while the inflation is at 7%. You need to invest that money at a higher rate of return than 7.1% to be able to hedge against the inflation. Thank you for all our viewers. We look forward to discuss further in the next video. Thank you.